Today we explore the banking innovation lifecycle using our proprietary model and use it to explore some of the emerging digitally enabled possibilities, and also look at which elements within banking are dying on the vine. Hi, I'm Martin North, Principal Analyst at Digital Finance Analytics. Using our primary consumer digital adoption research, as recently presented in the newly released Quiet Revolution report, our series of spotlight articles on Australian fintechs, and our broader banking sector research, we have developed a schematic which presents the range of emerging and dying capabilities which banks and other financial sector firms need to manage. I'll start by describing the concept and then walk through the list of disruptive forces pressing in on the sector and identify those which are on the up, those at their peak, and those falling away towards oblivion. This is from an Australian banking industry perspective. The journey we are on can best be represented by a simple line chart. On the left is the hill of innovation, where the new concepts and capabilities are emerging. At the top is the plateau of ubiquity, and to the right is the slope of decline. Along this line, we will place our list of elements. But before we do that, note that there should be a different strategic driver in each phase. Items sitting on the hill of innovation, which have future potential, should be a focus of investment, experimentation and creativity. Those on the plateau of ubiquity should be exploited to the max, whilst those on the slope of decline should be managed down, requiring disinvestment optimization and a focus on reducing and handling stranded costs. In our experience, many organisations are unclear about where to apply these different strategic responses. Within the life cycle, we identify a series of zones which helps to focus the strategy appropriately, numbered from 1 through to 10. Items in the first bucket are early stage ideas whose potential may be large but are yet to be proven, whereas stage 10 is the final stage in terms of managing down and out. So with that introduction done, we can now start to populate the playing field, recognising this is my opinion, though informed by my own research, analysis and industry dialogue. So let's start in the first zone on the hill of innovation. Our first is open banking. Today, banks hold massive amounts of information about us through the transactions we make. Open banking marks a fundamental switch centred around customers getting control of their banking data and then choosing to share information proactively with other providers. This offers the potential for product innovation, the opportunity for new players, and for consumers to switch more effectively. In Australia, we are awaiting the proposals as to how this will be implemented here and what protections need to be in place. In other countries, they are further down the track. Next, and still in the first zone, we have placed Siri-like banking agents. Siri is one of a fleet of voice-enabled agents which changes the way we interact with technology. Google, Amazon and other players are also developing these new interfaces, supported by artificial intelligence and deep analytics. This can fundamentally change the way we manage our finances, make payments, and even apply for loans. In the same early phase of development are product optimization agents. These agents will be continually monitoring our financial profile and seeking out better product options based on the best rates available or other factors. Eventually, we will find these agents are able to switch in real time, thus ensuring we get the best deals at a point in time. This would take latency and lethargy from the system and stop the current trick of attractor offers degrading over time. Moving up the hill, next we come to robo-advice. This is a capability which has been much hype, but is yet to prove its mettle. The core idea is that financial advice, investment advice, and other financial matters could be handled by automated robots using structured and templated advice formulas. This could provide mass affluent segments who could not otherwise afford tailored traditional financial advice, getting appropriate advice. There are a bunch of regulatory questions to be addressed. For example, if a robot makes poor advice, who is liable? Next, we look at customer centricity, something which has been paid lip service to by the banks up until now. But in a consumer-driven, digitally enabled world, suddenly it is critical. Here, we're talking about building services from the customer end in, with a focus on the usability and customer experience. This is something which tech firms like Apple and Google have been focusing on for several years. But currently, most banking experiences, even those delivered by banking apps, are product-led, not customer-led. This requires a fundamental change in perspective. Also in the second zone is peer-to-peer lending. This has been growing quite fast now and has started to evolve as the models and investors, especially from Main Street, change. A recent report looking at the US suggests digital lending will grow significantly. Digital allows borrowers and investors to connect on the lending platform, supported by the appropriate risk analytics and pricing. However, it appears that there are some behaviours which look more like subprime lending, and more regulation will probably be required. Next, we look at digital wallets. While virtual wallets have been around for years, the arrival of the mobile device now offers the potential to have a secure wallet, which can contain account and payment facilities, as well as rewards and personnel identification. It essentially replaces a physical wallet and forms the basis around which many other services could be built. This is being held up in Australia by the battles between the tech firms and many of the big banks, especially around Apple Pay. Now into Zone 3, where we find machine learning. This generic capability has now started to come of age. Essentially, it gives computers the ability to learn without being explicitly programmed. This creates the potential for exponential growth in system capabilities. This can facilitate better customer analytics, segmentation, and insight. So at its heart, it means that computers can find hidden insights without being explicitly programmed. Also in Zone 3 is Australia's new payment platform. The MPP will be open access infrastructure for Australian payments. The intention is that all ADIs will connect to the MPP either directly or indirectly through another member, so that they can process a wide variety of fast, data-rich payments for their account holders. ADIs can choose to join the MPP at any point in its development and operation. The MPP central infrastructure is on track to go live by the end of 2017, and participants will commence launching services to their customers from early 2018. Initially, they expect about 4 in 5 Australian accounts will be reachable, and this number will only grow over time as more organisations join the platform. Expect value-added services to be available later. We also put mobile payments in Zone 3. This is because whilst there has been a massive take-up in mobile devices, mobile payment capabilities are hampered by disagreements between key industry players. The fact is, the mobile device can be the secure payment mechanism, and this has the potential to replace plastic cards and cash, and make payments faster and with more data enabled in the transaction, providing the potential for more added value services. In Zone 4, we include gamification, which is the application of game design elements and game principles in non-game contexts to increase consumer engagement and utility. Current examples include apps which help to make savings fun, cash flow management a breeze, and investments simple. Simply put, it builds the experience from the consumer perspective and adds in utility which is useful and perhaps addictive. It's about changing behaviour. Also in Zone 4 is end-to-end loan processing. Loan application assessment and fulfilment is in many cases today a complex and manually intensive process. Using the right technology and business systems, it is absolutely possible to automate the process, as demonstrated, for example, by TikTok, an Australian mortgage lender who has taken the time for an improved loan down from 22 days to 22 minutes. See our recent FinTech Spotlight post. Next is customer analytics, which is a process by which data from customer behaviours is used to help to make key business decisions via market segmentation and predictive analytics. A consumer's digital footprint holds tremendous insight, especially when transaction information, social and online activity are all corralled. This has the potential to predict the next logical product, make suggestions even before consumers themselves realise what they want or need, and even drive specific marketing campaigns. Also in Zone 4 is online loan applications. Here we're talking about using apps built from the consumer end, which makes the application process easier and more intuitive. Functionality would include entry validation, the ability to upload and read documents, e.g. payslips, ID validation, and progress tracking. Many players claim to have an online process, but below the hood there are many manual workarounds, and it's a lot of smoke and mirrors. Now we move into Zone 5, which is near the top of the hill of innovation. We start with social media payments. Rather than using a standard bank transfer, these apps allow users to make payments in real time via social media platforms without having to know bank account or sort code details. This makes the whole payment experience easier, reduces errors from miskeyed information, and reinforces the importance of the social media platforms. Also in Zone 5 is segmentation. This is a critical and deep capability which recognises that not all customers are the same. Segmentation can be used to cluster into a few large groups or down to a market of one, where each consumer is seen as a unique individual. Effective segmentation can be used for specific targeting, product design, and customer value analytics. Biometrics is another Zone 5 capability, whether it's the Face ID, which is used in the new Apple smartphone, or fingerprint or voice recognition. It removes the need for passwords to be remembered and helps consumers to engage with digital technology in a more human way. Commonwealth Bank has announced it is the first Australian bank to offer customers secure access to their accounts using Face ID. Westpac's followed suit as well. Next, we move into Zone 6, which is now firmly in the plateau of ubiquity. Our first function here is mobile banking. This, of course, covers dedicated apps as well as access on mobile devices to internet banking. A recent Quiet Revolution report highlighted that the majority of households now access banking services on their mobile device, and the adoption rate has climbed to be their main access route. There are some who are yet to migrate, but they are now a minority. In terms of functionality, households desire to do more than is currently on offer, from loan applications through to payments and money management. Near-field technologies means some mobile devices can now also tap and go. Also in Zone 6 is tap and go payments. Using a payware or PayPass credit card is a fast way to pay because you don't have to swipe or insert your credit card in traditional POS terminal, and there's no PIN or signature required. Debit transactions should also be possible via the FPOS system, although there are still issues and currently merchants are paying through the nose. The RBA is now involved and has recently warned the industry to get its act together to avoid regulation. Moving on to Zone 7, which is now towards the end of the plateau of ubiquity, plastic cards. As a carrier for a payment chip, whether debit or credit card, are likely to be replaced by the embedded technology in mobile devices. As a result, we expect a significant reduction in plastic cards in circulation as the mobile wallet adoption continues to rise. Therefore, this capability starts to slide into the slope of decline. We also added mortgage brokers into this zone, which may appear strange when more than 50% of new loans were originated by brokers, according to recent research. However, given the uncertainty about broker remuneration and the new wave of digital loan origination services, we think the current mortgage broker model has limited life expectancy. Moving on, in Zone 8, we have internet banking. Once again, this is being outplayed by the new mobile digital services, as illustrated by statements from the banks recently. NAB, for example, highlighted the transition to mobile, with more transactions now via mobile than internet banking. This is tricky, as internet banking will still have a role, but the writing is on the wall. Phone banking is in the same zone. As more households migrate to digital, they are less likely to pick up the phone. Investments in phone-based voice recognition are now getting obsolete, and the volume of calls is on the decline. Thus, this channel alternative will decline in importance. ATMs are further down the slope of decline, with the volume of cash withdrawals falling by about 1/4 in the past couple of years. As a result, the banks recently abolished ATM withdrawal fees, and we expect to see a consolidation in the number of devices deployed. Having been around for close to 50 years, this technology is now close to the exit, and ATM networks need to be managed to avoid stranded costs. We put cash in Zone 9, and it's linked to the ATMs, of course. We're using cash less as we make more payments electronically. Even small payments can be made on tap and go or by digital means. Some countries, especially in Scandinavia, are actively managing cash out of their economies. Also in Zone 9 are bank branches and bank tellers, both a natural consequence of the digital migration and the fall in cash in circulation. Traffic through branch networks is falling fast, with a consequential fall in the number of branches, staff in them, and service availability. We included a section in our report, The Quiet Revolution, on this. Analysis from the APRA Point of Presence database shows that the total number of branches fell significantly between 2014 and 2016. There were 6,263 in 2014 and 5,628 in 2016. More are closing as we speak. Finally, right down the slope of decline are cheques. Usage plunged 20% to 111.6 million, the largest drop ever recorded in 2016, according to the Australian Payments Network. The value of cheques dropped by 6% over the same period, after remaining flat in 2015 and dropping by less than 1% in 2014. Over the last 5 years, cheques have dropped 56%, and this will clearly continue. So there you have it. A whole range of new shiny things will shape banking in the years ahead, whilst others, which have been the cornerstone of banking for years, are set to decline and wither away. This highlights the tricky problem banks face. The digital revolution has in fact just started, and the complex migration journey needs careful management. It's like flying an aeroplane whilst changing the engines from propeller-driven to jets, without falling from the sky in the process. What's fascinating is that the rate of change is now being driven by consumers and their aspirations, mediated by digital technology. To my mind, the three with the greatest potential are open banking, mobile payments, and machine learning. This summary is based on the Australian context. If you are somewhere else, then your mileage may vary. If you have suggestions as to what we should add to the list, or where things should fit, do leave a comment below. You can also request a free copy of the latest Quiet Revolution report, or subscribe to receive future updates. And we will update the innovation lifecycle map periodically as the revolution continues. It will be an interesting ride. Thanks for watching.